Yikes. The most recent CPI inflation report just came out. And when you contrast this to the BLS just revising the last year's worth of jobs data down by 911,000 jobs, I've said this in previous videos. We are the closest we've been in a long time to stagflation. Stagflation is the worst possible outcome when it comes to the economy. So we must try to avoid this as best as we can. So let's go over the main numbers, and that is core CPI and regular CPI. So core CPI did not change. 3.2 last month, 3.2% this month. That is still significantly higher than the 2% the Federal Reserve wants. Remember, that eliminates volatile assets like food and energy prices. The number that did tick up is the headline CPI inflation number, the Consumer Price Index. This tracks everything, okay? This ticked up from 2.7% to 2.9%. So you have an acceleration, once again, of inflation. Now remember, we need high interest rates to fight inflation. That is why the Federal Reserve has kept their interest rates high. But at the same time, it is almost guaranteed that the Federal Reserve is going to cut interest rates in September because of the jobs data. Not only was there a massive BLS revision, the Bureau of Labor Statistics, but the last 3 months, they were all revised horribly downward. Okay, I'll put all the numbers here on the screen while I talk about it. I've made videos on them all before. The point is, the jobs market is not growing. And when you take into account the fact that we need 70 to 80,000 jobs per month added just to keep up with population growth, we have been in a negative job growth territory for quite some time now. And then on top of that, you had the massive BLS revision of 911,000 jobs, just poof, disappear, gone. Okay. So when you combine that together with the fact that the Federal Reserve, because of that, is going to lower interest rates in September, it is basically guaranteed. You can check out the CME Fed Watch tool. I encourage you to do so. It is basically guaranteed. That tracks the odds of an interest rate cut. When you combine that with now this CPI inflation report showing that, look, inflation is still here. It is still persistent, and it is not moving down to the 2% target. And on top of that, you have tariff inflation looming in the distance. That is going to hit us. Okay? I don't care, which side of the aisle you're on. If we just look at it logically, when you increase an input cost, which it's already showing up in the PPI, when you increase an input cost like tariffs, you're going to get higher prices. Now, the Federal Reserve thinks that this is going to be a one-off or one-time event, which means you're going to get higher prices, and then that'll be that, because the tariff costs will be incurred, and from that point forward, it shouldn't necessarily show up in inflation. Fine. Maybe that's the case. It's still going to hit inflation, and when you combine inflation with a bad jobs market, you are entering the territory of potential stagflation. Again, for those of you that don't know, I'm sure if you follow this channel or you watch finance-related content, you already know what stagflation is. But if you don't worry. I'll give you a brief summary. It is horrible. It is awful. It's the worst economic event that can happen because of how difficult it is to fix, because the Federal Reserve has really two tools in their toolbox. They can lower and cut interest rates to affect the economy, and they can do quantitative easing and quantitative tightening, which is relatively new. They've always bought treasuries and securities, but to the extent that they do with quantitative easing, the first time that was used was in 2008. Okay, so it's not like something that's been going on forever, even though we hear the term everywhere. The problem with stagflation is, hence the name, you have a stagnating economy and you have increasing inflation, stagflation. Because of that, what can the Federal Reserve do? Okay, so they wanna fight inflation. Okay, so they raise interest rates. But remember, that has an opposite effect on the jobs market. That means you're going to raise the unemployment rate. You're going to lower the amount of available jobs in a time where the other half of the equation is stagnation of the economy. So you're going to lower jobs in a time where the economy is already slowing. Okay, so in that instance, well, maybe they should cut interest rates, right, to prop up the economy, to prop up the jobs market, to prop up GDP growth. Okay, but then inflation is going to increase because when you cut interest rates, inflation increases because cutting interest rates is inflationary because you are, by the literal definition, making it easier for people to access money. So stagflation is so dangerous because you as the Federal Reserve, which is probably the most powerful economic institution on the planet, they only have two tools in their toolbox, and they do the exact opposite things. You either make access to capital easier or you make it harder. That's what both of those tools do, keeping it super, super simple. Yes, there are some other effects, but to the core of it, that's what they do. So, and then you have problems that literally the cure for one problem creates a symptom in the other problem, which is inflation, if you're trying to solve the job market. And then the cure for inflation causes a symptom in the jobs market because you raise interest rates and the job market tanks more. So stagflation is, we had a scare, and I talked about it, in about 2021, 2022, right, when inflation was crazy. And then the Federal Reserve pumped interest rates super high. Plus the jobs market was already shaky because of pandemic-related issues, which, there was a scare of stagflation. We were close. We didn't get there, thankfully. Well, now it looks like it's happening again, and I think this time we're closer to stagflation than we were before. I hope we avoid it. It is not a situation we want to be in. It's difficult to fix, and there will be a lot of economic turmoil and financial turmoil if we end up there. Now, I don't want to drag this video out too long for no reason, so I'm going to just say this. I will keep you posted when it comes to this as best as I can. If you like personal finance, world economics, and investing, you are in the right place. If this video was informative, please consider subscribing. If you haven't done so already, it's hard to grow here on YouTube. It's very difficult to grow here on YouTube, so every single subscription means the world to me. So please consider subscribing if you haven't already. With that said, I do videos here pretty much weekly, sometimes more than weekly, because the economic news has been crazy. So I will see you in the next video, probably very, very soon. Until then, I just wanted to provide you guys with a quick update as to the situation. With that said, I hope you have a fantastic rest of your day, and I will see you in the next one. Take care.